Right. Welcome, everybody, to Wall Street Reporter's Stock, a live stream for February 2nd, 2021. We have back with us Skylight, Pred, the CEO. Pred, welcome back.
Hey, Jack. Glad to be back. Thanks.
Pred, our audience, again, they're looking for those 10x to 100x upside stocks. That's what we're here, to bring them with our live stream. Skylight is definitely, it's had a very good start. Since we began. January for you has been really, I guess, a very busy month. You've had some, acquisitions you've announced. You got the institutional meetings, and today you have this really important news. I think I would say it's a pivotal announcement about the remote patient monitoring, the rollout of this. So before we get into that, right, and we talk about all the exciting things, the big growth initiatives for 2021. For anybody that's new to the story, tell us what Skylight does in the U.S. Multi-trillion-dollar healthcare market.
Yeah, so Skylight Health, we're a U.S.-focused healthcare services company. We play within the insurable services market and underinsurable market within the U.S. You're right, Jack. It's a multi-trillion-dollar healthcare industry. We're a different story. We're a public platform with the capability to consolidate and acquire today, a 70% fragmented industry in the U.S. that is ripe for consolidation, with significant experience in bringing these kinds of healthcare services together and creating a ton of organic growth and value and a lot of sort of utilization to currently relatively, assets that they can certainly benefit from a lot of structure and capacity and management expertise. It's our goal to generate, a business that can easily hit $1 billion in revenue and plus within today that multi-trillion-dollar healthcare industry. We're playing along the likes of other billion-dollar revenue companies like Oak Street Health and One Medical. And we're quickly executing, and I expect to start to catch up to these companies, in a relatively short period of time.
Pred, I love the Skylight story. In fact, you got me so excited that I hit the desk and the computer started bouncing here. So what I think the key thing is, what's most compelling for investors is that not only you have this big consolidation opportunity, right, which you're executing, and you have a growing pipeline. Every time we speak to you, there's it keeps expanding. Obviously, as the stock is moving up, you have more opportunities. But I think the key takeaway is that you're able to, your real strength is increasing their organic revenue. Really like by factor of, you say 10x, right?
Yep. So, this was tried years ago, right? In the late 90s, companies in the US, public companies were trying to roll up primary care clinics and try and create this network effect and the scale effect. And, it's a well-understood market on the US side, but unfortunately it didn't work. And, a lot of that is right time at the right place. And honestly, today Skylight is at the right time at the right place. We didn't have the technology. We didn't have the funding models. We didn't have the communication. We didn't have the transparency in order to make a model like that work. And, for the last 20 years, we've been doing it successfully and recognize, obviously, the maturation of that industry today. So today, we still have the same type of fractured industry in the US, where over 70% of healthcare practices in primary care are running independent. And there is this huge push to consolidate, because the more patients you have, the better your contracts, and ultimately the better the returns from an insurable services model. But there isn't a platform like Skylight today that has the ability to consolidate at our level. We're playing in a unique niche today where there are far few competitors. We're buying assets at very attractive multiples. And to your point, Jack, you can improve costs all day long, but what value can you really bring to these clinics? And you're looking at opportunities where clinics are generating on average of $150 or less per patient per year. And in our models, at minimum, they should be at $1,000 per patient per year. And our Blue Sky takes us over to $10,000 per patient per year. And this is built on a very real, replicable model that we have succeeded with in the past. And so today we have the technology. Today we have the transparency. And we have the management expertise and an active market that is ready to hit reset on the strategy. And Skylight's right there within one of the largest healthcare markets in the world, looking to achieve sort of that next generation of success.
Okay. And really so, you're in how many states right now in the US?
So 15 markets now and soon to be 16.
Okay. So you're gonna be in 16 markets, and you have over 100,000 patients.
Over 150,000 patients, actually. Yeah.
150,000. So it's growing. It's
grown. It's grown.
Okay.
Yeah.
You got 150,000 patients. So now today's announcement, the remote patient monitoring, this is started rolling this out, right? So can you explain what that is? Kind of the business model and what that really means for Skylight in terms of revenue opportunity this year.
Yeah. Okay. So we talk about this organic enhancement, this value, which, by the way, this is what investors want to see. This is what institutional investors want to see. Anybody with money can go buy anything they want, but how are you going to build real value? And so this is an example of where real value comes from. So you take hypertension, where today, over 40% of our patient population could potentially benefit from improved services within. The partnership we have at GatherMed was announced a couple of months ago, where we now will offer our patients this remote patient monitoring device supplied by GatherMed. And our nurses and doctors will provide remote monitoring. So patients don't have to travel to take their blood pressure anymore. Everything can be done remotely at home. It communicates via Bluetooth. It's integrated into our technology. And for reviewing and monitoring it, first of all, it allows us to be there for the patients and proactive if we feel like we need to recall the patient or get a hold of them. But for providing that service alone, this one product within a certain category of patient condition falls within potentially a $2,000 a year per patient revenue billable model, where insurance compensates us as an organization monitoring fees annually or monthly, that leads to annually up to $2,000 per patient per year. So just, based on a small subset of patients, even if you take a third of our patients today, that's over 100 million in potential annual revenue just on this product alone. Now, let's ask the question.
Hold on. So $100 million in potential revenues, and that's based on a third, based on 50,000 patients.
Based on 50,000 patients, yeah.
You have 50,000 patients. So basically, how many of the whole pool could benefit from the remote patient monitoring?
So we estimate right now it's about 40 to 45%.
Okay.
Yeah.
Okay. And so in other words,
and remember that patient count keeps growing because every time we acquire.
Right.
Correct.
Okay. So this is this is just one example of how you're able to increase revenues, on that patient base. Okay. So it's 100 million. So if you stop, like right now, if the company did not grow anymore, so potentially you could be doing 100 million in revenues with a third of your people. What are the margins on this?
A little over 60%. So quite strong.
Okay. So, that in itself could be worth, $1 billion valuation, based on, more than $1 billion valuation based on, some of the comps in the market out there with, what is it? The Oak Street, the One Medical, Teladoc.
And even that would be less. Like Oak Street and One Medical are trading at 15 to 20 times revenue. So, you're looking at 1.5 to potentially $2 billion at that point if you're using, fair market comps.
Okay. And how many shares? So right now, how many shares are outstanding?
So there's about 175 million shares today.
Okay. So 175. So in theory, just with this initiative alone could be worth $10 a share without anything else.
Just with this initiative alone. But I know you're focusing on this one initiative, but this is an example though, Jack, of let's call it 150 per patient per year on average to 1,000 or more, right? And so, this is one example of a tool, and we've certainly got more that we're working on that, we'll hope to, bring to our patient population soon enough. But if you think about the organic growth within each clinic that we're acquiring, each practice that we organically grow to, that revenue should far surpass just this basis alone. But to your point, yes, one product, one service could generate this much in return. Okay.
So this is pretty compelling. So I mean, just this one initiative. I mean, it's kind of mind-boggling, but really, just this one initiative could be worth $10 a share right now.
It could be, yeah.
So interesting. Okay, so I want to get into some audience questions here because we're getting some good, and that's kind of really the idea here is we want to.
Yeah, absolutely.
One of the questions we had, which is one of the things I wanted to ask you, is Andrew here. Okay. Prad, what has been the feedback from institutional investors you've been meeting with? You started I think just in January, right? With the JP Morgan conference, you kind of started going from there.
Yeah. So, it's been, thanks for the question. So it's been extremely busy, and it's only going to get more through the month of February. So we have been very active, both US and Canada, and doing a lot in the US as well, both through our own sort of roadshows with investors, but also now through some of the larger banks that we've been working with. And the feedback has been pretty much, on point with the same thing we've been hearing so far, which is this is a unique story at a unique time at a very opportunistic moment in US healthcare, where we are going to see more money being spent in primary care and in healthcare to create access for patients at a lower cost. And it's going to be a trend that you're only going to see, now further advanced by a Biden administration. And we're already seeing that today with changes to the Affordable Care Act, for example. So there's certainly a lot of excitement. There's been a lot of demand. And that is the demand that ultimately, we know that today can't participate on an OTC market listing, but is eagerly awaiting, a NASDAQ uplist. And so this is part of sort of the overall strategy to understand the book of demand, figure out sort of who the right institutional players will be. But it's all been nothing but positive. And, I will say also that as much as they appreciate the M&A activity, they really, really like to see how we're going to create organic value within these acquisitions.
Yeah, I mean, okay, so it's very interesting because right now you're meeting with meeting, I guess it's all by
virtual
or whatever, right? So now all these, so essentially you're building kind of this pent up demand because a lot of these guys, like you said, they can't really buy the stock until it's in NASDAQ, right? Especially the bigger institutions, has to be NASDAQ for them. But they get the story. I think one of the things is that you're really a lot of these guys, they're looking at the comps. So you're very cheap compared to, the One Medicals, the Oak Streets. And is there anybody else, who else is what other peers do you have in the public market right now that are kind of doing something similar? Is there anybody else?
Yeah. So you said two things. So one, direct peers for us in the US market, not really. I mean, you start to talk about sort of the much larger organizations like United Healthcare, but I mean, very different models altogether. Right? But no one really that plays in our subsector today. And that might change in the near term. We're going to start to see. But here's the other thing, companies like, larger groups, private organizations, whether you think of, larger consolidators like Privia or VillageMD, which are all relatively private organizations today, these companies are going to demand a much higher share price because, they're far ahead in terms of revenue and where they stand today, which creates another really interesting dynamic for Skylight Health, which is, what is it today? I think we're heavily undervalued. We're trading at little over 4 times, forward-looking revenue in terms of our acquisitions that we'll look to close this quarter. Let alone where we were before at 7 to 8 times fair market value, where they were seeing us as cheap. Today it's even cheaper. And so, the way I see this is, and what I'm hearing is, this is only getting more and more attractive. It is a low entry point into a high growth story within a sector of the market that is going to get a ton of attention, both from the markets and from the government in terms of funding. And, I think it's a perfect storm, Jack. And I think that's what we're going to see as we continue to move forward. And that's what we've been doing to be very careful, ensuring we have paved a pathway forward that we know is going to resonate well with, real high quality institutional shareholders.
Yeah, I think one of the catalysts, again, one of the things that we look for, with our kind of next super stocks is, these companies which have, they're addressing, massive multi-billion-dollar opportunities, multiple catalysts, and they're a key inflection point. So Skylight meets all three of those. So the NASDAQ thing for Skylight specifically I really believe it's going to be one of those catalysts that is really going to move the stock, because again, the U.S. institutions love the healthcare space. They love consolidation stories like yours, especially if you can you can show that you're adding value, as like you're doing with today's announcement, which is going to be once again, all these guys, they're following what you're doing, right? So once they see traction, and so then they can model that out, and that becomes like an institutional favorite. Everybody piles in, and the thing goes to 100. In theory, it goes to 100. But why not, right? I mean, let's talk about the M&A pipeline.
Yeah,
the retail audience, our audience, they love hearing about M&A all day long, right? They don't want to know about it. They just want to know news every day. That cadence of deal flow. So you announced you announced this deal in just a couple of weeks ago that's going to get you to what are they doing? They're doing 20 million revenues right now.
20 million, yeah. So that gets us close to about 45 to 46 million in annual revenue. Yep, and about 10%, 12% in EBITDA. So, we're adding profitable assets. We're leveraging cash and debt to be, the most effective form of acquisition pricing today. I mean, the price was based at 4.5 times EBITDA. So again, we're demonstrating our ability to really kind of find good deal flow here. I think, so I also want to address, Jack, I know part of this question that's come up for me, and I'm sure there may be a question on this call is, what about the Florida acquisition? So we've made 6 acquisition announcements in the last 4 months, 4 have closed. So, I certainly want to let everybody know that there's no concern with regards to Florida closing. In fact, I would say with some relative confidence that, all the checks have been checked off with regards to getting the deal closed. But, now that we're trading on the venture, there's, sort of an additional regulatory approval that needs to come in place. And so there's, I guess, just been with an overarming, amount of demand in terms of their time, a little bit of delay on the exchange approval, which, we expect to receive imminently. And so, we certainly look forward to announcing the closing of Florida, which will certainly add to the continued, trust in execution. What we've announced, we've closed, and we expect to be the same moving forward. But yeah, let's look at M&A, Jack.
This is the moment everybody's been waiting for the last 17 minutes. They want to hear about the pipeline. Then we'll get to some more questions. So, here's what's interesting. Since you began with us, you got on our live streams, everything you've said you've been delivering, right? Which is very important. I mean, so you talked about the M&A pipeline. You've been delivering on the pipeline. So right now, February 2nd, what does your pipeline look like?
Yeah, I mean, look, when I came on 4 months ago, I said we started with 10 million, it grew to 50, it ended the year with 75. And I'd like to give myself room to grow, but let's be honest with you, it's a 200 million plus. And, let me kind of walk you through a really interesting dynamic, Jack, that I'm certainly really excited about, and something that's been continued to demonstrate itself as an opportunity for us. So this large acquisition we made at the $20 million deal that we're buying for 14 or so and change. This is an example of a network acquisition. All right. So it is a multi-location practice that is resourced. It has the management team, and it has a 2 to 3 to 5 year growth plan that is going to look to significantly expand growth on its own. And there are, like this, so many different network players across the US today that I would say this is probably the smallest of the ones I've seen. I mean, we're looking at deals that are 40 million, 50 million, 60 million in revenue. And again, I think that's still scratching the surface. Here's the opportunity. These transactions are typically sponsor backed, right? And so they're not founder anymore. They have VCs, private equity. Now, management wants to run these companies long term, and the sponsors want liquidity. And so eventually they just sell to another private equity group. Well, here's an opportunity. Skylight has a platform today that, unlike others, has the ability to access equity capital through public markets that today nobody else does. It has the ability to incentivize sponsors by providing currency that will see value over time. And it has the ability as operators to let the management teams build and grow their companies. And so we're entering a phase where we are starting to see Skylight not just as a consolidator of independent, smaller sized transactions, which we are, and that still is very much a real target for us, but the ability for us to play within a much larger sandbox where today the only other option for these larger size players is a fixed multiple EBITDA exit to private equity where they may not get the same return long term and it's not aligned with management. So, I am more excited now as this continues to grow. We're going to get access to a stronger market in the US from institutional support, strategic institutional capital, and we are going to be able to start to play within this sandbox. And I'm fully confident in saying that these are some of the deals right now that fit within the pipeline that we're looking at. And so from an M&A perspective, I've just upped my target in terms of what I think we can do over the next 2 to 3 years, just inorganically. And, I know people don't want to hear about organic, but you're talking, 100, 200, 300% return in growth on these companies organically. So, that's how you get to $1 billion quickly.
Okay. So the takeaway is, I think, is that your the size of the deals that you're doing is really increasing. You're about to kind of enter a whole new world, like this kind of like elephant country essentially, which is these $50 million type networks. How many of them are there, do you think, that are in play, so to speak, at any moment?
Thousands. Yes. I think there are those that are in play, and I think that those that will come to market as soon as you start to knock on the door. And
they see. So let's say, I'm going to be conservative. I'm going to say NASDAQ. Let's say 6 months. I'm just being conservative. I'm not going to say, hey, it's going to be next.
Sure.
These things always take a long time. But let's say it's 6 months from now. So by August, right? So by August, you're a NASDAQ. You have the institutions start coming in. The stock. I'm not going to make projections, but let's say the stock is, you're going to have a lot more growth. You're going to have things are going to be better, I believe, in 6 months, than they are today. So all of a sudden now you're going to have all these private equity firms that have these portfolios. They're going to be looking at you as this is the vehicle. This is they can put get these health networks into Skylight. They get shares, and it's a win-win. Here's a question: what do you think you can exit if you do a couple of these deals, right? In how many do you think you can do? Let's assuming you're a NASDAQ, right? Let's say you're a NASDAQ today, right? How many of these deals do you think you would be able to do? 50. Let's say the $50 million range.
I think at this point in time, in terms of cadence, we can probably add 3 to 4 deals a year. And that will increase year on year, right? So as you're growing, you're building conditional strength and foundation.
And you have that, and the organic thing kicks in. So it becomes like a what do you call it? A virtuous cycle.
You're building cash flow to fund acquisitions. You're building market share to you're building your valuation to continue to increase on deal size. And you're not biting off more than you can chew. And that's what's truly important to the U.S. institutional investors. How are you going to deliver growth? And so I think this cadence that we've developed for ourselves is very possible. And we're proving it out. And that's that gives me comfort in saying that at least in the near term, that's how much we can move on. I think our biggest challenge is going to be taking on as much opportunity and then closing on as much as we can. And so that's a good problem to have. And my take on that is always, there's ways to strengthen and build a foundation so you can continue to ingest. There's a window of opportunity, and we certainly are going to maximize that window.
Okay. So so let's say so let's say 200 million revenues. And I think it's important to emphasize for anybody watching that, hey, essentially you've delivered everything you've promised. So this credibility here. So let's say you exit 2021 at $200 million run rate. There's a probability.
Okay. It's a probability. Yep.
Reasonable?
It's a reasonable probability. Sure.
Okay. So 200 million, right? So really that would be worth, based on peers, $3 billion. Market,
based on an undervalued asset today, just $1 billion on its own. So yeah.
You have more shares out, but it could be still. I mean, I still see a path. I see really a path for this to be a $10 stock by the end of the year.
Look, the reality, Jack, is you're buying companies. Let's say you paid 5 to 10, depending on how these resource companies price and trade at. But even if you do, you're buying companies where, let's say, 5 million in EBITDA, 50 million in revenue, 60 million in revenue, and you're buying them for $50 million, right? What's the value to us? Well, for Skylight shareholders, that's worth 300 million to 600 million based on a 5 to 10x multiple, which is still cheaper compared to where the industry peers trade at. So with that level of growth in accretion, if we did nothing else but just acquired all day long, you can see how that growth starts to replicate at a very rapid pace. Now, in the organic growth in there, I think that's where you drive those multiples higher and you start to get that institutional support long term, which helps you get the higher comps, ultimately creating a better value overall in the share price. But just along the opportunities that exist with consolidation in the space and the level of fragmentation, this is like I said, right time, right place, and executing in the right market.
Yeah, so it's. I mean, once this thing is on Nasdaq, I mean, Skylight, it's a phenomenal institutional story. I mean, like we talked about. Okay, so let's address kind of the elephant in the room, which is there is discussion of a potential reverse split in order to get onto Nasdaq. Also, give us what's the story there? What are you going to do it? Why are you doing it? Give us your thinking there.
Yeah. So look, there's no certainty, right? And I guess everyone's looking at what was filed today with regards to the shareholders meeting. They'll be coming up in February to approve up to a 5-to-1. So that's the key. It's up to a 5-to-1. I think what we want to do is to make sure we have all our ducks in a row, so that when it comes time to listing on the Nasdaq, we're not sitting with any bottlenecks that we need to then delay. Timing is everything. The market is extremely hot right now. Deals in our sector are heavily 5 to 6 plus times oversubscribed. There is a lot of institutional demand today that cannot participate, right? So, what we're doing here is just creating the opportunity for helping the process move timely, and that's all it is. It'll come down to two things, Jack. It'll come down to price, and it'll come down to capital structure. Now, there are much smarter people than me helping to steer our capital market ship, and this is not an inexperienced team. I mean, this is the team that took GrowGen from $3 to $46 from the OTC to the NASDAQ. And, this is the team that understands institutional demand and what it means to create the right synergy of investors, post-market support, and what the market will listen to. And if those that don't know GrowGen, it is a consolidation with significant value growth within the retail sector on the US side. And so it has many of the same effects that Skylight has. Skylight speaks to a very similar story within a different sector that today is also receiving a lot of attention. So, we are going to listen to smart money. We are going to take the advice of proven capital markets strategies. And that's what I said in the last call. We will only do it when the foundation is built the right way. And we are taking it step by step. We are doing all the right necessary steps. We are meeting with institutions. We are taking in the book of demand. We are looking at feedback, and we are making deals to continue to build the value of the company until then. And February is going to be a very busy month for us. I mean, we are marketing all of February to continue to expand the story. We have a lot of eyeballs on the stock that I get today cannot play on the story, but all that means is that is a ton of demand on the sidelines just waiting for an uplist to happen. So, take that as you may. But the way I look at this is, it's going to mean that whatever we do to be successful on the NASDAQ is going to be successful for everybody, which includes management that today, are significant shareholders and have continued to, voluntarily extend our own no sells just to show confidence that we are behind what we say.
Okay. So you're behind the GrowGen story.
Sorry, Jack, you cut out on me there. I apologize.
So your key investors, like
yeah,
major investors.
I mean, look, GrowGen was one of Merida's top successful picks and success stories, and Merida remains our largest foundational private equity investor. And we have a lot of aligned folks that have seen this work before and are attuned to what makes it work again, right? So we're certainly not following, without any proper guidance. And there's a strategy that's worked for the company until here. But let's also be honest. This is not a public market story without the fundamentals to back it. This is a company that is generating aggressive revenue growth, a lot of organic value over time. It is generating strong positive earnings, and it has the ability to accelerate growth with a broader market access. And that is what is being communicated and understood within the U.S. confines of institutional investors.
Okay, no, so this is it's like when I look at Skylight, I mean, like all the the stars are lining up. I don't know if it's
It really is.
Yeah,
It really
it's like everything really. It's like everything is kind of lined up so that once the stock hits Nasdaq, which that's the perfect. That is the perfect market for Scott. I mean, that is for some companies. It's not. It doesn't make a difference if they're on Nasdaq. But for Scott, that's the institutional. That's the platform for health.
It is the answer that everybody is waiting for. That is interested in the story. That understands how much of an buying opportunity this is today, given the valuation of the company comparable to its peers, and given the runway for growth that we have in front of us. Right.
So essentially, right now, I mean, based on the comps, the stock. I mean, that one. Okay, so one of the catalysts is just that valuation gap closing is 4x. I mean, that's really worth basically $5 a share Canadian. So if in other words, if you were just trading based on the comps, I don't know why you're not trading. I mean, at that 20x, because you're doing all the same things they are. I mean, you're growing at a faster rate than they are. So it's just I think this is a massive opportunity for investors. But okay, so I want to get to a couple more questions. We're running out of time here. But okay, so George is asking, when can you disclose some metrics that demonstrate the uptake SHG's experience? I guess the organic growth is referring to.
Yeah. So with every acquisition, there's always an ingestion time, right? And so typically we kind of look at 3 to 6 months before deals start to get to a point where we can start to implement change, because you want to make sure these clinics, ingest successfully. So, I'd say certainly the second half of this year is going to be where you start to see those numbers probably reflecting. And when we look at organic growth, it's not just on new patient acquisitions. We're buying established practices where the value we're bringing is the enhancement of revenue driven by an existing practice. And so it's how are we enacting change to create more increased visit frequency that will lead to insured billings, that will lead to increased access for other services. So, the organic platform that is driving value growth here is how do you bring a more disciplined approach to an existing practice, which will then result in a better, improved financial outcome for the business itself.
Okay, Pred, let's wrap up. Over this coming month, what other kind of news flow can investors look forward to the next, let's call it 4 to 6 weeks?
Okay, so I mean, look, I think we're doing all the things we need to be doing, which is, past 4 months, we've brought some pretty significant acquisitions. We're going to be focusing on closing all of them. So that's number one. We got to stay true to what we announced. And so we've got 2 left, which will be done. And it's a question of just getting them done. So that is going to be our focus, is closing the acquisitions. Number 2, strengthening the foundation. We've added on, a really experienced and U.S. focused centric public markets and operational board member in Grace. We'll be announcing some additional key hires. You could think of this as now Skylight is starting to institutionalize our organizational structure and really bring on that expertise that understands how to run multi-billion-dollar healthcare companies. And so that is going to help create further organic expansion, but also successful ingestion of these acquisitions. So those are things that we'll be working on very aggressively in February, along with communicating and expanding the roadshow and continuing to get more institutional support for the potential NASDAQ uplist. And look, for anyone that wants to hear it, there is a second wave of M&A activity coming. And, the first one that was done in the early part of January was just the beginning. And these are bigger deals with more materiality. And there are some smaller transactions there as well that build density. So there are some big, some small, but there is an active pipeline that we're working on. And for anyone that knows sort of the diligence we take on this, we like to do some upfront work to make sure it's a deal we really like and we think will add value. So expect those types of news flows to certainly come to market. And then lastly, we're, like I said, we have a very active market down south, and we are, positioning ourselves to become a leader within the space today that largely doesn't have, a lot of competition. but has very near-term comparables that show sort of the valuation gap on Skylight today to where we could be at. So those are going to be our focuses over the next several weeks.
I just want to highlight this comment from Wahid. He's making a very, very, very good point, which is that, a lot of times reverse splits, they get kind of like a bad rap that, because he's making the point that, hey, the reverse split is only bad. We've seen it when companies are forced to do it so they don't get delisted. So it's those stocks that are going, they're going in that kind of ski slope when they're, going below $1, then they're forced to do it. So they have problems, which, is not related, but when it does it to get then it works out. Especially, I think, especially do the reverse split as you're doing it you're going like into strength, so that you have, again, this is, everything's kicking in, revenues are exploding. Then the market understands that there is a reason why you want to, again, tighten up the capital structure and to appeal to those institutions. So it's, I don't think that's going to be an issue. Let's see here. We got let's make another. Okay, so IPA did a 5-1. Yeah. So it works. It works out.
Yeah, and look, Jack, for the audience to hear, it's not just about the share price, right? I mean, you're right. This has nothing to do with share price. This has to do with, it has to do with share price, sure, but it has to do with the right structure, right? You're going to tighten the float. You're following the recipe of successful stories with the right set of institutional backing behind the story. Institutions drive valuations on NASDAQ, and you're doing it with a ton of catalysts and to come, news flow that's going to continue to just keep demonstrating success. Sure, $5 to $10 is great. I want the GrowGen $3 to $46 to more, and I want that for the company, and I want that for our shareholders. And that's what we want to deliver here. And we're focused on a much larger growth plan here that I think will focus on continued execution like we've always done, but for our shareholders, seeing that aggressive growth along the way.
Prad, usually I ask at the end, the famous question, top 3 reasons to buy. I think we've already mentioned 100. I mean, we've pretty much said it all. So this is fantastic. Prad, okay, thank you again for updating the audience. And, hopefully we're going to have you back on this month, maybe several times, right? If you have some news.
Yeah. Look, well, we're going to have more news certainly coming out, and I look forward to coming back on and unpacking that news flow.
Prad, thank you again.
Thanks, Jack.